So, what makes more sense? Lump sum investing or dollar cost average? A 2021 Northwestern Mutual Life Study showed that investing a lump sum has outperformed dollar cost averaging over periods of time. But you have to keep in mind that the study was done based on past historical returns, which don't guarantee your future results. And I'm sure you've heard that before, right? So let's say you have $10,000 that you want to invest into an index fund. If you invest all $10,000 in one day, then that's called lump sum investing because you're just putting that entire money into one transaction and investing it all at once. This situation is pretty common for people who receive an inheritance or who left an employer and rolled that old 401k into a new 401k or an IRA, right? And I actually lump sum invest my backdoor Roth IRA conversion every year, but that's a topic for a separate video. So let me use the S&P 500 ETF as an example. If you lump sum invest $10,000 every year from January 1st, 2014 to January 1st, 2023, you would have just over $200,000 with an average of 13% return annually. We had two down years from 2018 and 2022. You would still have $100,000 in principal and $101,000 in total earnings. And you can check out my compound interest calculator by visiting firesightchat.com/resources if you need to fact check it yourself. And what if your dollar cost average your $10,000 by investing $833 every month for the next 12 months based on the historical data from 2014 to 2023? You would have about $190,000 by the end of 2023 with an average annual return of 12.3%. That is a difference of about $11,000 over the course of 10 years. And keep in mind that all of the data I'm showing you right now are from 2014 to 2023. Is lump sum investing always going to be dollar cost averaging? We won't know until the very last day of the year, right? And here are some pros and cons of lump sum investing. And I am a long-term investor, so I like the fact that I'm putting my money to work as soon as possible. If you're 15, 20, or 30 years from retirement, lump sum investing might be the right option for you. You also won't have to stress about the best time to buy investments. You just let your portfolio ride it out with the market. But the downside of lump sum investing is it may discourage you if you're a brand new investor and you experience a bear market in the first year. If 2022 was your first time investing your $10,000 into an S&P 500 index fund, you would have finished the year with about $8,200 that year. Okay. And that's about an 18% down, right? And the other downside of it is that if you need to sell the investment right away, you're going to end up owing short-term capital gains tax for the entire profit you made from $10,000. It is from one single transaction. And if you dollar cost average throughout the year from January to December, you can pick specific tax lots inside your portfolio so that you can reduce your tax liability. And if you receive an employer match from your 401k, it is better to dollar cost average by the frequency of your paycheck so that you don't miss out on the match. Some employers will give you the match regardless of your contribution schedule, but most employers will stop giving you the match if you have already maxed out your contributions. Okay. And lastly, I prefer to dollar cost average due to psychological reasons. The stock market moves in waves. Okay. It doesn't move in a straight line every year, right? So whenever there's market volatility, I just buy a little bit more so that I can get a discount buying into the investments. Not every single year is going to go in a straight line from 0 to 13%. It's not going to go from 0 to 12.3%. It could be down by 2%, it could be down by 5%. And then eventually it just goes in waves and goes up. Some years, like 2022, we could finish the year with negative 18%. In 2018, it finished the year with the negative 6%, right? So psychologically speaking, I just buy a little bit more so that I can get a discount buying into the investment. And it just makes me feel a little better about investing throughout the year, not knowing how the stock market will perform in the future, right? So right now, let's say in July, looking back, of course, everyone would say, man, if I had put more money into, let's say, the S&P 500, I would have made this much return. But at the beginning of the year in January, you're not going to know how the market is going to do for the rest of the year. There are a lot of articles saying that there's going to be a bear market, there's going to be a recession, that type of thing. The recession hasn't come, right? At the time I'm recording this video. But when you're dollar cost averaging into the investment, you do feel a little better because you're just kind of like, oh, the market is down, I'm buying. The market is up, I'm still buying. That's really kind of what drives behind dollar cost averaging. Okay, even if you don't make as much as lump sum investing. By the way, I am so fired up to announce the launch of my private FIRE community for people just like you and me who are passionate about investing, saving, and achieving financial independence and exploring different possibilities to retire early. My private community will allow you to connect with me on the platform and get in touch with other like-minded individuals or couples who are just as serious as you are with the FIRE movement. As a member of my private community, you'll get resources like investing, saving, paying off debt, or finding the right place to grow your money. For a very limited time, please enjoy the free trial by clicking the link in the description below. And when it comes to investing, you have to first understand your risk tolerance. And allocating your investments to more stocks will give you a higher return than allocating some of your investments to bonds, right? But when we go through a bear market, you could see some losses in value if you have more stocks allocated to your portfolio. So how do you balance your portfolio based on your risk tolerance? Maybe you're someone who is completely comfortable with having 100% invested in stocks, but maybe you're someone who can't stomach the short-term losses because you're close to your retirement age, right? So when you hear the word risk, look at this S&P 500 chart. How does it make you feel? Do you become worried about losing your returns, or do you feel thrilled about the opportunity for great returns? Your risk tolerance is all about your behavior. Some people naturally don't like to take any risks, but they have to understand that they're not going to get a greater return on their investments. If they don't invest in stocks, right, then you're not going to get the better return than, well, let's say if you just put all of your money in bonds, you're just not going to get as much return from stocks. That's just based on historical returns. But if they take too much risk, right, then they could potentially lose more than they should if they invest in something way too volatile, right? And I was very risk averse when I first started investing because I didn't quite understand how the stock market worked at the time. It was only a few years right after the global recession in 2008 to 2009. So I had no idea how our economy or the stock market would move forward after that disaster, right? So you have to understand, or first understand, your financial goals so you don't make a costly mistake. If you put all of your money in a bank account, you're not going to generate any earnings or wealth, but that 0.02% in interest. Even in a high yield savings account during the height of inflation, it gave us 5%, but it still did not beat the S&P 500 when it performed 20% or more in a year. This is also known as the opportunity cost. If you look back at 2008 and 2009, would you go back and invest in the S&P 500 at, 1,000 points? You're of course gonna say yes, right? Smart investors will consider both risk and return. A smart investor doesn't put every single dollar in bonds or cash because it's barely going to keep up with inflation every year. A smart investor puts their dollars to work so that they can grow to achieve financial independence. But you also have to remember that even the most conservative portfolio can experience short-term losses due to market volatility. 2022 was a perfect example of when both stocks and bonds were down. So if you take a look at this chart from Schwab, assuming that you started investing $10,000 every year from 1970 to 2014, having 80% stocks. Let me draw this. Look at the aggressive portfolio. If you invested 80% stocks, 15% bonds, and 5% cash, will give you a 10% average annual return, or $892,000. Having a 60-30-10 moderate portfolio gives you a 9.4% average annual return, or $676,000. And a 30-50-20 conservative portfolio will only grow to $389,000. The 80-15-5 allocation isn't necessarily the most aggressive fund, like this chart says, but you can see that it had the highest annualized return. But if you look at the volatility here, okay, it had a maximum loss of 44.4%. from 2008 to 2009 under the aggressive portfolio. People who stomach those losses actually came out on top with more money invested at the end. The conservative portfolio only suffered a 14% maximum loss, right? But the total return was not even half of the most aggressive portfolio. So when it comes to deciding your risk tolerance, you need to understand your limits and how much you can stomach short-term volatility. What is your time horizon between now and your financial goal? How many years until you reach your retirement age? What are your personal circumstances that require you to be more risk averse? Investing 100% in stocks isn't always the answer for everyone watching this, because not everyone has the same financial goal, right? You can always schedule a consultation with me by visiting 5 com/consultation to discuss your financial situation.